Hi, this is Alan Gassman. Welcome to this webinar broadcast to talk about Hurricane Ian relief. I know a lot of you have had some horrendous situations, or you have family members or friends who have had horrendous situations. You have our condolences and our sympathy. Our office was unscathed, but some parents of employees and some property of employees were severely challenged. We had one family that had to put on life vests along with grandpa and swim from their home and hold on to a bank awning in Kissimmee and wonder whether an alligator was going to eat them. We have another employee whose parents completely lost their home and in Southwest Florida. So thank heaven that this storm was not nearly as bad as it could have been. I'm joined here by Carl Mill, who is a wonderful lawyer who specializes in charitable taxation and planning, and with my partner Ken Crotty, and with Peter Farrell, who is a student at Stetson Law School and has been doing a great job clerking with us. So one thing I'll mention, of course, this does not qualify for continuing education credit. If you have signed up for this, which obviously the attendees have, then you're going to receive an email pretty soon in about 2 to 3 hours that you can click on and hear this again, and you can forward it to a friend. If you have questions, you can click on the question inverted pyramid and type in your question, and at the end of the presentation, we'll go through the questions and we'll answer them to the best of our ability. You also have or will be receiving our Thursday report, which has articles on some of these topics. And I'm going to go here to Carl first and let him lead us through his slides. And Carl, I'll be glad just to move the slides as you tell me if you don't have control.
Okay, sounds good, Alan, and thanks for the introduction, and good to talk to everyone again. I'll acknowledge, like Alan said, our condolences go out to everyone affected. I'll also acknowledge this is a bit of, this is going to be a tax presentation about disaster relief. It seems like maybe a strange time to be talking taxes, but this is the rules that we're going to be talking about as they apply to charities are sort of rules that be helpful to understand as you or your company or your charity or your foundation want to do something to help mitigate the harm caused. So this is all, this is sort of tax law with a purpose here. Let me, don't think I have control yet, Alan, so I guess I'll go ahead, and if you could move the slide ahead one, perfect. Obviously we're talking about this because this is sort of perpetually timely to talk about disaster relief. I was going to have transitions, but I will just talk about it one at a time. I think the biggest reason when we talk to clients about disaster relief, there's always this fear in the background that the money they give is not going to go where it's supposed to go. So whether that's your company or you or a charity wanting to find a good place to send money, knowing it's going to help, that's part of what we're talking about here, and how to establish an organization that will do disaster relief the right way instead of having it be done the wrong way. It is becoming increasingly common, and I think in some cases even expected, that when these things happen, employers step up, certainly large employers step up for the communities they operate in. That'll often mean giving their own funds or gathering from employees, gathering funds for for people impacted by disaster. Which brings up the third point, there's right and wrong ways to do this. There's ways to do this that can be really effective and helpful, and there's ways to do this that would, where these sort of strategies can backfire. So we want to understand the right way to do it. Lastly, when done right, there are, there's a tax efficiency and bonuses. There's sort of benefits to be understood by using a charitable vehicle to do this. We'll talk about exactly how that works in a minute and why. This is sort of what the charitable vehicles are for. I also want to call out something I did in two. Something people often don't understand is an option here, is the idea that you can actually focus your disaster relief on particular categories of people. It doesn't have to be for everyone impacted by the disaster. It is possible to raise money for a specific group of people, and even the families of your employees and your employees themselves. Again, if it's done right. So to that end, by the time you're done, you hopefully sort of understand what the options are for giving in that way, for establishing a fund in that way, and so that we can go through here. I'm just trying to kill some background noise as well. I can. Excellent. So I think the next slide would be another sort of why are we talking about this now? I think obviously those of you in Florida, I'm calling from California. I know in Florida you just had a disaster, and in California we have multiple disaster seasons where there's fire season, there's earthquake season, there's just all sorts of disasters at all times. And this is sort of a rough chart I put together based on some rough data, but you'll see that these sort of number of federal disasters are going up over time. In California, you'll see, in the 80s and 90s, it was one thing, and now 2020, we had over 300 nationally declared disasters. That's almost a disaster a day. So we will be focus on how those can be, what that idea means, idea of federal disaster, and also how how the prevalence of this gives opportunity for this sort of setting up funds and planning. Real quick, this is what I'm going to try to cover in the time we have. These are sort of the key concepts. I also want to call out, like it says at the bottom, the IRS actually has a really good publication on this topic, called Publication 3833, that walks through the disaster relief. So these slides are available. Feel free to download, read over. And I also encourage you, if you're a tax preparer, if you have a company that's considering a fund, or you're individually thinking about making some gifts or doing some disaster relief work or creating a charity, it's a really good place to start to understand. I'm going to walk through what I think of as kind of the key principles and what I've learned in the course of advising nonprofits about disaster relief, what the key concepts are. So you can kind of see what the topics are there. We'll just jump right to the first one, which is sort of these options of how you can give to provide disaster relief. I don't know if you could flip the slide, Alan. It lets me. I can't do a presentation like this without creating a chaotic chart, and this is my one chaotic chart for the day. I'll kind of walk through what's going on this chart. Let's start on the left side together. The left side, the leftmost option represents what sort of happens most of the time when a disaster happens and there's been no sort of planning as to how you might do disaster relief. You have the employer that might want to pay out some additional extra money to employees, and just say, okay, we're going to make additional payments to our employees and to their families to help them recover from this disaster, and we'll raise money together from the co-workers. So you'll see I have this kind of thumbs down, thumbs up matrix. I'll explain why they're the way they are. But let's say you're making the payments in the context of a disaster, and they're not what we're going to call 139 direct payments later. That means it's not a federally qualifying disaster and you haven't met certain safe harbors. You're just handing out money based on people have had a hard time. Well, anytime an employer pays money to their employee, it's assumed to be compensation, right? So then a couple of things happen. The employer has, you're making these payments, you're also going to pay additional payroll tax on those payments because it's payment to an employee. Just as unfortunately, you were trying to get $10,000 to their employee and they're going to receive $6,000, $7,000 because it's taxable income, unless an exception applies. Payments from an employer to an employee are compensation. So this is sort of why I have it as a thumbs down. It's not really an optimal way to go about it. On the coworker side, the good news is when people give money to other people, that is excluded from income. Just like when you receive money on your birthday, that is not taxable income for you. It's also not deductible to your grandmother, whoever it was that sent you the money. But it is, it's not deductible by those individuals and it's not income to you. So for sort of peer-to-peer fundraising, what you might think of as sort of GoFundMe disaster relief fundraising, you might see, these can work okay and then don't have any severe negative consequences. But as you'll see, as we move to the right, there are still better ways to do it. So sum up the first scenario, these are non-qualifying direct payments, no planning whatsoever, just handing out money. It's going to be treated as comp from the employer, and it's just going to be a regular old gift like any other from coworkers or other individuals. We go to the middle column. This is where the employer is paying enough attention to make sure the payments qualify under 139. You'll hear more about what that later means, but it means it's got to be a federally declared disaster, and you got to make sure you tailor your payments in the right way. If you follow those rules, the good news is that this isn't taxable income to the employee. No payroll taxes paid. They get the full 10,000. They're not stuck with the after-tax amount. So that's great. So as a starting point, it's going to be good to understand those 139 rules, just to see if there's a way to avoid that taxable income to the employee. And then for the coworkers, it's still the same result. Still just a gift, disinterested generosity, not included as income, and therefore, sorry for the background noise there. Not included as income and not deductible to the donors. Now, the premise of this presentation is you'll see, so in the middle we have one thumbs up. You go all the way right, we have 2 thumbs up across the board. The premise of this presentation is sort of the most efficient and tax efficient and therefore effective way. The way to get the most money to people in need is to find some sort of a charitable vehicle. And the good news is that there's ways to do that involving an employer, not just having it being a specific class. So you'll see in this scenario, when we do everything right, we have from the employer, okay, good news. 1, it's not going to be taxable compensation. 2, it's going to be a charitable contribution deduction. Now, if you really want to get in the weeds about whether it's better for an employer to take a business deduction or a charitable contribution deduction, we might find that the business deduction can be better. I'm still going to present this as favorable because now the employer gets to report a charitable contribution. That can have a halo effect. If we talk about some of these options, there might be a company foundation that can be a positive way to build goodwill. So ultimately, still really good from the employer's perspective. They get to make payments. There's no compensation, no payroll tax. On the coworker side, now they get charitable contribution deductions to the gift, because there's no gifts for giving to your friend who's been hurt in a disaster, but there is a deduction for giving to a charity that might help people like your friend who hurt in a disaster. So we've sort of made this a better result for the coworkers you're raising money from as well. And as in the last case, employees and their families won't receive any taxable income for receiving money from charity. So this is really the best of all worlds, and why when we're talking about this, and as opposed to, you can always just hand out money, but if you want to hand out the most money most effectively, using a charitable vehicle might be the option. And with that, I'll pivot to the next slide and start to get, okay, we know it's great to have the charity, but with charity comes rules. That's why people like me exist. And let me talk about what some of those rules are. I will start with a basic principle, which is why is disaster relief charitable. I think for some people this seems self-explanatory, and it mostly is. It mostly works the way you would expect. You're providing relief to people from suffering, and one kind of charity is providing relief to the needy and distressed. People harmed as a result of a disaster are generally going to be people in a charitable class that deserve funding, and I'll talk about a little bit of an exception there. This extends to financial assistance. So disaster relief isn't just about pulling people out of the rubble, immediate medical need. It's also about so-and-so's home was destroyed, so-and-so's business was destroyed, so-and-so's source of income, and they're no longer able to feed or clothe their family. As a company, a charity can be established to provide some of those needs. But similarly, it can include financial assistance to businesses when you do it right. I'll go back to the when you do it right thing as an important part of this, because there is a way to do it wrong. Generally speaking, when charity and business intersect, you have things to think through. You have to think through things like, how do I know this charitable money is not going just to benefit local business? That's not a charitable purpose. That being said, even the IRS in this publication is saying there's ways in which can be charitable. If the business is owned by someone in financial need, financially distressed, that can be a reason to support the business. Lessening the burdens of government. There's a government program you're helping carry out to bring back business to a disaster damaged area. That can be a charitable activity. Combating community deterioration. This neighborhood's been destroyed and we want to see it recovered as a result. That can be a charitable activity. You're always going to have that last clause of that sentence, that the private benefit is only incidental to charitable purposes. A lot of weight gets put on the word incidental in our sector. And to me, I think what it means is any private benefit, the business is benefiting, it's a byproduct of the charitable good you're trying to do. It's not the purpose, right? It's a thing that happens along the way. It's not something you're trying to create. You're not doing this disaster relief because you really just want to stimulate the growth of local gas stations. It's really because it's the people who own the gas station that have been harmed, or somehow the gas station's employing many people in the community and they're all harmed. Those are when charity and business can intersect. Let me get some key concepts on how to do it wrong. Something you can't do is earmarking. Earmarking is almost always a bad word in our line of industry. So what you can't do is give to charity and say, hey, charity, you need to give it to this particular person who's been harmed by the disaster. Maybe that person's my friend, maybe it's a family member. I'm going to give it to you, but you have to give it to them. That doesn't work. That just because I told you at the beginning, when you give your coworker money, that's not a deductible gift. So you don't get to stick a charity in the middle and make them give it to your coworker. But the good news is you can give to that charity for providing disaster relief in your community. That community might include your friend, and your friend might end up getting that money. But you need that charity in the middle to not just be a pure conduit, a pass-through. These are all bad words we can use. The charity needs to have a moment in time where it decides who it's going to give it to, and it's going to give it to your friend, or maybe the neighbor to your friend, whoever they think, using their own processes for determining who it is. Charitable class needs to be sufficiently large or indefinite. So there's a lot of charities, or a lot of attempted charities, that have failed and been denied status or revoked by the IRS or accused of tax fraud when if you set up a one-person charity. So you may have a family member who's in financial need. If you set up a charity just for that person and to only serve that person, it's not a charity. That's sort of a fundamental principle of both state and federal law. Any sort of charity needs to operate for a large and indefinite group of people. This comes up in the context of disaster relief, not just because someone might try to set up a charity for their particular cousin or friend, but also because the IRS has said you can't have a charity for one disaster. You can, when you raise money, because if you raise money for one disaster, well, we already know who the people are, sort of a definite class of people that have been impacted by that disaster. It may end up being true that all the money you raise for disaster relief is used in the course of responding to the most recent hurricane or fire. But it can't be limited that way. So if you create a fund, you want to make sure you're raising money for disaster relief generally. And obviously you can, one of the things we're going to focus on is this particular hurricane, but you don't want to limit it, because if you run out of money, you need something else to spend it on. Or if you have money left over, you need something else to spend it on. And this last one is the kind of most interesting one. Not all victims of disaster are members of a charitable class, and you'll see there's this difference that's going to recur between short-term and long-term relief. Before I get into the weeds of it, let's just kind of talk through an example. There is a fire, a home is burning, the person comes out, they are in pain, and they need medical care. As that person approaches you, you notice that person is Elon Musk. Can you feed him, give him a blanket, help him put out the fire, put some bandages? Is that a charitable activity? Can you spend charity money on that? Well, the answer is yes. In that moment, yes, you can. And after that's over, you representing your charity or talking to Elon, he says, well, thank you so much. I see you're on a charity. Well, my house just burned down. Can I get some funds to rebuild my house? It's at that point where you need to say, wait, you're Elon Musk, you're the richest or second richest person in the world, depending on the price of Tesla that day. No, I can't. This is your charitable funds. Once you get past that sort of short-term moment, that moment of providing direct relief, it goes back to being about charity. And charity is generally about need, and need is generally about financial need. There are certain other kinds of charitable classes, but generally speaking, if you're not financially needy, you shouldn't be getting money from a charity. There's areas of charity where that's not true, for example, education, but when it comes to charity, when it comes to financial relief, you need to be a member of a charitable class. And so you'll want to be thoughtful if you're doing this. And this comes up more often than you think. I've worked with charities. There are any number of mass shootings over the past 2 years. And I remember one charity I was working with, I believe it was the Gilroy mass shooting, was talking about, hey, we want to provide relief to some of these people, and obviously we want to just pay for their medical care and pay for their homes, and it's really, well, that's great, but you need to get some W-2s, get some affidavits. Like, do they have the money? Could they pay for this themselves? And the sort of initial emotional reaction was, well, that's crazy. Why would we need to do that? They've just been in this horrible event. And then the answer is, yeah, but when it comes to charitable money, if they have the means to pay for it without your money, they're supposed to pay for it. You're not supposed to give charity money to people, even if something bad has happened to them. You can't give money. So sometimes it's thing that maybe makes sense from a big picture, but people sometimes get sideways about when it comes in practice. You have to ask people for financial information and provide relief, but that's how it works. When we talk about using a charitable vehicle, we're talking about using a regulated vehicle that has rules, and so this is one of the rules. And we can talk more about how that works as we go on to the next slide. Yeah, this gets to documentation. Riveting topic, I know, but where there are rules, there's documentation because you need to prove that you follow the rules, right? And this, you'll see, I won't go over line by line, but I have sort of the list of what the IRS thinks you need to do when it's long-term aid and what you need to do when it's short-term aid. You'll see the short-term aid at the bottom is significantly lower, right? It is shorter because it's just this. That's the documentation you need to keep when Elon came running out of his house. Look, we gave blankets, we gave some bandages. What were our criteria for dispersing assistance? They were obviously hurting. We're helping people in obviously the aftermath of the event. We did it on this date. We spent this money. That's really all you need to do on a short-term basis. Long-term, it gets into this issue I just talked about, which is you need to have some proof that you weren't giving money to Elon Musk or people who have plenty of money to pay for the relief themselves. And so you'll have this stuff about how they were selected. You want to make clear you'll need to keep records as to whether these people have a relationship to your directors and officers. It's not necessarily, we'll get more into it, but it's not really a strict prohibition to give to these people, but you need to make sure you're not formed to give to the family members of your directors. And I think we'll get more into the other ones as we go forward. So I think we can go to the next slide, but please come back to this. If you ever start a charitable activity, understand this is the documentation you have to keep. I probably should have walked through this at the beginning when I skipped over the outline. This was the useful thing to talk about, but I'm going to break the world of things you could set up for a charitable vehicle into 3 categories. And before I do that, I'll break the world of 501c3s into 2 categories. First, we all know what 501c3 is, but sometimes we lose track of there are really 2 kinds of 501c3s. There are public charities and there are private foundations. So public charities are charities that raise money from lots and lots of people. And they are the Red Cross, community foundations, lots and lots of other stuff. Also schools, hospitals, other things. When it comes to disaster relief, if we're talking about a charity, this is when we're talking about a company affiliated charity, this is a public charity that is affiliated with a particular company, but it's qualifying as a public charity because it receives donations from enough public people. Sometimes it's just this company has a lot of employees working from it and they all give. I've seen that be an example. Other times it's, the company started the charity, but it's actually kind of grown beyond the company and different people are giving to it. So if you have a company and you want to start a disaster relief fund, let's say you want to work with a company affiliated charity, this is going to be where the regulation is at its lowest. Why is that? Well, it's because public charities get the better end of the rules than private foundations. Private foundations are usually funded only by one family or one company, and therefore the IRS looks at them most skeptically because they don't have to answer to the public, they just have to answer to their company. So here, this is sort of the most flexible way to give. You'll see that if you want to set up an employer-specific fund, so this is a fund that is for the benefit for the benefit of people who've suffered from the disaster that are either employees of the company or family members of the employees in the company. You as an employer want to offer that and say, we're going to give $1 million to this fund. You do it at an affiliated charity. All you need to know is that the class of beneficiaries needs to be large or indefinite. So my law firm is 7 people. I don't think we could do one of these. I don't think we got a large enough charitable class to pull that off. If I were Coca-Cola, pretty sure we'd have more than enough people that employees of Coca-Cola and their family members, that's a very large group of people. Where the line is in between is always a little hard to say, but I wouldn't think of it as colossally large, maybe 50, 100 in that tier. You kind of want something at least that big. There's examples of that being a large enough charitable class. But if you're a small company, you should at least be asking that question before you start a fund that is only for 5 people, because that kind of violates the rule I just talked about, that you can't earmark for particular people. The recipients need to be based on an objective determination of need. Sometimes when you think about, obviously, everyone that is applying is presumably going to be in financial need as a result of the disaster. So it's going to be all that evaluation. I also want to emphasize what you shouldn't be doing. Whenever there's sort of a charitable fund that's tied to an employer, the IRS is looking out for this idea that what the fund is really doing is paying compensation to employees that it wants to reward and pay more, and that's not really about the disaster relief. And so when your charity is making these selections about who's going to get the money, you want to make sure it's really completely independent of that. And so one of the ways is, okay, what's your objective determination? They have this amount of money, these things happen to them, they have these bills to pay. That's great. One way to reinforce that is that if this is a company affiliated activity, you want an independent selection committee or similar procedures. And I would just say, just do a selection committee to make sure that the benefit to the employer is incidental and tenuous. If your selection committee are the 4 supervisors at the company that decide how much everyone gets paid, that seems like a bad idea to me. Those people are not going to be operating independently. They're going to be thinking about who are the good employees, who are the bad employees. Oh, we were just about to fire that person. Now I don't really want to give them money. This is not what's supposed to be happening with the disaster relief fund. It's not supposed to be a performance reward. So that's kind of what we mean by an independent committee. And we have this sort of rule that if a majority of the members of the committee consists of persons who are not in a position to exercise substantial influence over the affairs. So you want a majority what sometimes is called as a majority rank and file. If it's a majority of rank and file employees, people that don't have the power to influence pay, performance, bonuses, et cetera, that's probably a good sign. Often if you're working in connection with an existing charity, it'll be people who are, I love to have it be a majority of the charity's employees serve as a committee. I'm sure they're going to listen a lot to the minority because they may know who the people are better, but I'd still rather have that buffer of majority control. So this is a company affiliated charity. And in some ways, this is the best option. It's also the hardest option to find. Why is that? Well, because usually there aren't a lot of company affiliated public charities. Generally speaking, the charities that are affiliated with companies are going to fall in the foundation category because the only people who are going to give to them are that company. Which means you're going to be more in this next set of rules as one of your options. Let me flip the slide here. Company foundation. So I probably spend about 50% of my time as an attorney for 501c3s talking about private foundations and the private foundation rules. One of them is self-dealing. So one of the consequences of being a company foundation or as a private foundation is that you're going to have self-dealing rules to follow. So this comes up, and this is consequential here because it means that if you get it wrong, when we're talking about a public charity, you get it wrong, there's not some direct consequence. What the self-dealing rules say is anytime the foundation uses its assets for the benefit of a disqualified person being the company or the people it owns or the directors or officers of the foundation, that's an act of self-dealing. Those people get hit with taxes, tax penalties, and they need to unwind the transaction. Well, the last thing you're trying to do in a disaster relief context is impose tax penalties on the people you're trying to help. So you want to make sure you're not violating the self-dealing rules as you do this. For a long time, the way the IRS describes it anyway, this sort of disaster relief by company foundations was more or less forbidden. It was assumed that it was self-dealing because, well, look, you're a company's foundation is only making grants to employees of your company. There must be some benefit to the company that's more than incidental, right? That was the theory. After 9/11, IRS softened these rules a bit to allow company foundations to set up more employee disaster relief funds. And the requirements are all basically the same as the ones we just talked about: independent committee, charitable class, objective determination. But this is where they added the requirement that the relief be for a qualified disaster. So a federally declared disaster. So that's going to be a subset of the overall amount of bad things that can happen to your employees. If you have a public charity, that's generally going to be able to help for all kinds of disasters. And doesn't really, what does the disaster mean? It could just be for employees and their families in need. Once you get to it being company foundation, we have this extra requirement, and it's only for qualified disasters. I'll also just add, it makes following these rules even more important because getting it wrong is going to mean tax penalties on the people receiving the money potentially, or the company, and it's not what you want. I will note the couple of last bullets. The presumption does not apply to payments to disqualified persons. So if you set up a company foundation, I would take those directors and officers off the list of eligible recipients of aid. They're not supposed to be the ones getting it. And frankly, just generally speaking, most company foundations, the people on the board probably not in that financial need category, right? So they are probably not the ones to be receiving grants, and you have a prohibition. And the last point is just you can lose that presumption if you do other things that seem to be providing incidental benefit to the company. Like I said, just be careful. Self-dealing is a hard rule to follow. It's something to violate. And I often just tell people, if you're operating this program in any way that's beyond just, we want to help these people and their families, if you start factoring in things like who's a good employee, who's a bad employee, how much did someone get enough of a bonus this year, you're doing it wrong. And not only are you doing it wrong, but you're at risk of violating the self-dealing rules. So I'd be really careful about that. So the sort of intermediate option that we haven't talked about is a DAF or a fund and a charity. And that'll be the next slide. For those, I'm going to give you 30 seconds on what DAFs are, because they're super important in the charitable world, and a lot of people know what they are, but a lot of people don't. So a DAF is not a separate legal entity. It is not a separate charity unto itself. It's a little bucket of money at an existing charity. Sometimes the DAF lives at a place like Fidelity Charitable or Vanguard or Schwab Charitable, these sort of big charities that are associated with banks for philanthropists to drop some money in. In this context, it's probably more community foundations that will host DAFs, and community foundations might set up a fund. So you likely could go to your local community foundation and say, hey, we're an employer here in this community. I'm here in Los Angeles. Go to the California Community Foundation, which is our community foundation, and say, hey, we're an employer here. We employ a lot of people in LA. We want to set up a disaster relief fund for our employees and their families. And now that would normally be a donor advised fund, because a donor advised fund is any fund at which the donor gets to continue saying where the money goes. And I'd probably toss this in that category if you're going to be on the committee saying where money's going, right? In those, generally DAFs can't make any grants to individuals at all. So when the DAF rules were first passed, this would have been prohibited entirely. Not long after they were passed, Treasury came out with an exception that said, okay, DAFs can make grants to individuals, or really technically something isn't a DAF, but you have to set up a separate fund, and it's got to follow all these rules. The key rule being you have to have the fund, and it's just for disaster relief, and it's just for qualified disasters. So just like foundations, you have that limit, that narrow limit. So this is something that pros and cons, let's talk them through. So the pro of doing a DAF, a company affiliated fund, an existing charity, a community foundation or otherwise, don't have to set up a legal entity, don't have to get tax exemption, you get to rely on theirs. The con, they're probably going to charge you a fee to administer it, and you'll have to follow these rules to get it set up properly. But otherwise, you'll see that basically everything is the same. You'll see that in addition to not benefiting directors or officers, it shouldn't benefit the sponsoring community foundation or whoever else is sponsoring the DAF. But basically the same idea. So we can to kind of recap these options. We have a public charity, company affiliated public charity, most flexibility if you can find one, but it's not easy to set up your own company affiliated public charity unless everyone loves your company and wants to give to support it. You're probably choosing between the second two options. You saw they both had this qualified disaster 139 requirement, federally declared disaster. And you saw they both come with these set of rules that basically force you, your company, to be in the minority of any selection committee. There's different schools of thought on how to staff it. You have the whole committee, but have rank and file. You can sort of follow these guidelines on how to do it. And what I would say is there's a number of community foundations that have done this. There's community foundations that work with other charities. I believe it's the Employer Assistance Fund is a good organization that both helps existing charities set up disaster relief funds for employers or sets up their own. This is an option. For some organizations, particularly if you're a company that expects to have some philanthropic goals, or employers that have philanthropic goals in the future, maybe you want to do a matching grant program, you might think about starting your own foundation. So I think the next slide, which I think is, if I'm remembering correctly, which is a really bad idea for me to ever go from memory, is the last on my part of it. Yeah, it looks like it. This would be, okay, what if you do want to set up your own foundation? Now, normally, we'll get to the bottom why this isn't unrealistic to do in terms of timing. But the basic steps for following, I always set up nonprofit corporations. It is possible to set up charities as a trust. I think for me, corporations, especially for something in like the company foundation context, often works a bit better. But both are options. Let's assume that you're doing a nonprofit corporation. You're gonna need to have articles of incorporation. You're gonna need to have bylaws. You're gonna need to have a conflict of interest policy. So the articles of incorporation is what the person who's creating it files to bring the organization into existence. I always tell people, you can do that in 24, 48 hours. That can happen right away if you want to get a charity up and running to do this. You'll do the bylaws, and in the bylaws, you'll think about how the board is going to be appointed. Well, that's super important for a company foundation. You could have it be so that the board of this foundation is wholly appointed by the company. So the company just gets to say who's on the board from time to time. So it's a company-controlled entity. Nobody owns a charity. You can't own a nonprofit, but you can control a nonprofit. And typically, you're setting a company foundation, that's what you want. So you're going to spend a little bit of time on the bylaws to make sure you do that right. You're going to pass a conflict of interest policy, in part to follow your corporate law rules about insider transactions. But for me, it's when I'm talking to a foundation, it's usually about, here's all the things you need to know about the self-dealing rules, or at least here's enough to know that you need to take these really seriously so you're not stuck paying a bunch of tax penalties to the IRS. When done right, planning ahead, easy to manage those rules. Going in ignorant, bad things happen. You'll need an action of sole incorporated. That's typically where the initial board is appointed, the initial officer, who's going to sign, all that stuff. Do your initial filings with your state authority. I'm in California, where there's lots of people to register with. In Florida and other states, you're probably going to find a few less things to register with. You might just need to register with the Secretary of State. Once that's all done, and like this is all stuff that can be done in a matter of days if you're motivated and trying to get your company foundation up and running. The next thing is the tax exemption application. I want to come back to that public charity operating foundation, private foundation thing, because I can't help myself, even though it's a bit tangential. I would say the main thing you're going to be looking at is we're going to file a Form 1023. There is something known as the Form 1023-EZ. That's only an option for organizations that expect to make $50,000 or less in the first 3 years. These are generally turned around a little bit faster, and sometimes people feel tempted to use it to get a faster response. But to be clear, you're not eligible for it unless you expect to only make $50,000 a year or less. And frankly, if you're expecting that to put that little money into the foundation, you're probably better off just doing a fund with a community foundation. My personal takeaway, I will say the even better in terms of expediting than the EZ is being able to expedite for one of the specific bases that the IRS allows. Usually it's pretty hard to expedite. You have to be able to show that if we don't get this determination letter by this date, we're going to lose funding that will really hurt us. So some people manage to always find that friendly donor that's willing to say that, but you don't need to rely on that here. And the good news about setting up a disaster relief fund is that's a basis for expediting your exemption application. You can tell the IRS this is our plan to establish this, and they'll expedite the application. How fast is expedited? I don't know, a month, 5 weeks. Sometimes it comes back in a week. The IRS is a mysterious place now more than ever. But I do think that it should. This is like if you got to the end of this presentation and your conclusion as a company or this company I'm advising, like the right thing to do is to set up a foundation. You can actually. This is one situation where you can move things fairly quickly. And I think with that, I'll pause my part of the presentation. I will hang around, and that way, if questions come up at the end that I could answer, I'd be happy to. But thanks again for inviting me, Alan. I always enjoy it.
Yeah, thanks, Carl. I think the one thing I would mention is that if you set up the foundation this week and get a tax ID number, you can start taking deductions before you have clearance from the IRS.
Yeah, and I'm glad you brought that up. And so you can start operating as a charity as soon as you file the articles, and you can accept money as soon as you file the articles and get an EIN and a bank account. The only limit on what you can do before you get a determination letter is what you can tell people. So you can't tell people we are a 501c3. We can tell people we applied to be a 501c3. We have no reason to doubt we'll get it. And it will be retroactive to the date we formed, such that your gift will be deductible if and when it's approved. But it took a couple more seconds for me to say than just we're a 501c3. But other than that, yeah, you can and should start operating. And there's really if you do it right, there's really no reason to doubt you will get the letter. So if the company is the initial donor, that's usually a good basis. And or you have friendly kind of key individuals, key directors, officers that are going to be making the initial donations, And that's a pretty easy thing to make a leap of faith on.
Yeah, and then before you start fundraising in most states, you'll file with the Secretary of State and just let them know that you're there. It's a simple
Yeah,
app.
the Secretary of State and depending on the state, the Attorney General. I know Florida has a solicitation requirement, but it's not the Attorney General. It's somewhere else. In most states, it's your local Attorney General.
Florida,
Right.
Florida is actually the Department of Agriculture.
That's that was my memory. Yeah.
Yeah. Okay, so who's talking on delayed deadlines? Is this you, Peter?
Yes, sir.
Okay. No, I hear him.
Well, Congress has given the IRS the ability in a federally declared disaster to push back some of the deadlines for filing tax returns and as well as payments that are due during that period. And so, let's see if I can, there we go. The IRS has published a news release in the last few days advising that those who are victims of Hurricane Ian in the federally declared disaster areas, which now include all of Florida and South Carolina, have until February 15th of 2023 to file those returns and to make the payments. The period is for any filing deadline or payment deadline that occurred starting September 23rd of 2022, and you'll have until February 15th to file those returns and to make those payments. One thing that's important to note is that it only applies if your payment was due during that period. So even if you have a valid extension on your return, but the payment was due back in April, you do not have an extension on that payment, just on filing the return. But there are some payments that the IRS has listed. They are found here, but I put them in a chart later on that I'll go to now. This is a good Forbes article that kind of condenses and puts in more easy to read language what was in the IRS publication. But here's a chart going through some of the tax return filing deadlines. You can come back and look at this slide if this applies to you with the prior deadline and the extended deadline. Again, any that were due during that period, September 23rd through February 15th.
Well, let's hold on just a second. Let's
okay.
First of all, let me mention, if you live in Florida, then you are a victim. So I've always felt like I was a victim, but now I have verification that, you know, if you live in North Florida that had no impact from the hurricane, you're on the panhandle, you're still a victim and you have the full advantage of this. And even if you died before the hurricane, your estate is a victim. So, and then let's go through this. If you filed an extension for your 2021 income tax return and it became due October 17, you now have until February 15 of next year to file it. That goes also for your gift tax return if you did a proper extension. Now, for an estate tax return, can we have until February 15 if you, as long as it was properly extended by when? I'm sorry, you're muted.
9 months after date of death, but for the decedent.
Okay. So we were in the middle of some tumultuous estate tax returns, and the hurricane brought relief to those estates. So then also your Form 1041s, your C corporation returns, your 990s for tax exempt organizations, your employee benefit plan returns, now, and your quarterly payroll and excise tax returns. But I don't see anything here about Florida returns, Florida corporate returns or Florida payroll returns. I assume that that'll be a separate law through the Florida legislature if we see it.
Right. We called the Department of Revenue on Monday, and the agent that we were talking to on Monday said that typically Florida follows suit with what the federal government does. It hasn't been officially announced yet, but if you do have a question, you could always call the agency directly, and they should be able to give you additional guidance.
Beautiful. So Peter, what else did you want to cover?
Well, I'll just go to this next slide, which are regarding the various payment and penalty deadlines that have also been extended to February 15th. And I said this before, but again, the important thing to note is it had to have been due during that period, not back in April or whenever the other date was that it was due. These include the quarterly estimated income tax payments. They're normally due on January 17th, but if you had any extension that was within that period, it's been extended to February 15th. Penalties on payroll and excise tax deposits. And also the IRS has pointed out that if you receive a late filing or late payment penalty notice from the IRS during this period, you should make a telephone call to the IRS and they will abate that penalty.
The tough part is going to get them to answer the phone.
Luckily, they're hiring. So
yeah. Okay.
That's all I had on the deadline extension.
Okay. Beautiful. So I'm going to talk just a little bit about the Section 139 deduction, which Carl mentioned. And I'm just going to bring up the statute here because you can read the statute just as easily as I can. Section 139A, gross income will not include any amount received by an individual. So you need to write the check or spend the money for a person as a qualified disaster relief payment. So what is a qualified disaster relief payment? B1, it will reimburse or pay reasonable and necessary personal, family, living, and funeral expenses actually incurred as the result of a qualified disaster. So this hurricane came through, I was disturbed, I have to see my mental health counselor. My back hurts from moving all the furniture on our porch and off our porch. I need to go see a massage therapist. My wife and I started fighting during the hurricane. I need to see a marriage counselor. Now, will this pay for your divorce? Probably not. I advise you not to get divorced. Somebody died, funeral expenses. People right now are living in their cars outside of their homes, using their homes for bathrooms, but not wanting to stay in the home very long because of the mildew and the mold, waiting for the insurance adjusters and the contractors to come by. Well, go stay at a hotel and have your employer write a check to you or have a charity write a check to you, and you will not have to pay income tax on that. And then number two, to reimburse or pay reasonable and necessary expenses incurred for the repair or rehabilitation of a personal residence. That's my home. I personally think that's my vacation home. And in addition to that, that's a home where I live that I rent. That's the personal residence, or repair or replacement of its contents to the extent that the need for that is attributable to the qualified disaster, attributable to the hurricane. So we carried the vases, in carrying the tables through the living room, we broke the vase as the result of the hurricane. So now my company can buy me a new vase and I won't have to pay income tax on that. Now, these only apply to the extent not payable by insurance, to the extent I don't get paid by somebody else. And under G3, no increase in basis. So if I spend $100,000 to fix my home and it comes from my employer, I don't get $100,000 more of income tax basis. Now, 139C, what is a qualified disaster? Well, it's number two, a federally declared disaster. 139D, if my employer pays this to me, says, Alan, you're a great employee, here's a check for your disaster relief. They do not have to pay employment taxes and they do not have to count this towards my pension contribution. So it's a great thing. It's a great way for employers to buy goodwill. Now, what about the non-discrimination provision? If I do this for myself as 97% owner of my company, do I have to do it for my employees? No, there is no non-discrimination provision here. What about if you're an S corporation? What about the rules about S corporation fringe benefits? Nope, they don't apply here. So while we can all use this, and we will use this to a great extent for our employees, if you are a small business owner, every dollar should be paid for by your company. If you work for your company and the company can reasonably justify that you're worth the money, and Carl, I don't know about you, but if this gets paid and bonuses are a little bit less in the summer or in the end of the year, I don't know that that causes you not to get the 139, the employer not to get that 139 deduction.
Yeah, I think it's good to. I agree with you. I think it's good to emphasize like these are the pros of not using a charity, right? Like sort of like if you don't use a charity, you don't have to think about whether the owner of the business is in financial need or not, right? You don't have to do that analysis, and you would be free to take the kind of approach that Alan uses. So yeah, no, so I agree. It's because we're not invoking the charitable rules. I don't think we have to worry about that.
Right, right. Okay, so we've saved the best for last, and Ken has learned all about casualty losses. Not that he didn't know about them before, but let me just say, you want to stick around and listen to this. What's real important is that you can file your 2021 return and take your casualty loss deduction and get a check from Uncle Sam right now. So if you've already filed your 2021 return, you can amend it and take your casualty loss deduction, and you don't have to spend the money yet to get the casualty loss deduction. If your home was worth $300,000 before the hurricane and it's only worth $100,000 now, and that's not going to be reimbursed by insurance, you can go ahead and take your $200,000 casualty loss deduction, and if you're in the 30% bracket, get a $60,000 check from the government, or wait till next year because you may be in a higher bracket next year. So Ken, take it from here. Thanks for waiting.
No problem. So, all right. So what we're going to talk about for the remainder of the period, like Alan said, is the casualty loss deductions. It's governed by Section 165 of the code. There are two main areas that we want to look at. One is if we're talking about a loss that was incurred in a trade or business. And one is if we are talking about a loss that we're going to call personal use property. So personal use property would be if you have your residence and your residence suffered damage as a result of the hurricane, that's personal use property. If it's a secondary residence that you own and you use it to rent out to, as an Airbnb or for other renters, that's going to be incurred in a trade or business. We would fall into that category. Now, under both categories, the basic rule is that you look at the fair market value of the property immediately before the casualty event, immediately before the hurricane. And then you look at the fair market value of the property immediately after the hurricane. So whatever that reduction is, you can claim that as the casualty loss, but in a lot of situations, you're limited to the amount of your basis in the property. So that if the reduction in the value of the property is $100,000, but your basis in the property is $60,000, in most situations, you're going to be limited to the $60,000 deduction. And similar to what we talked about before, if you have a $100,000 loss and you receive $40,000 worth of insurance to compensate you for that, you're only able to claim a $60,000 loss. So whatever loss you are able to claim is going to be reduced by any insurance that you receive after the loss occurs. All right, so then if I can scroll down, hold on one second. There we go. All right, so one other item to talk about is related to the trade or business. And this is an exception for trade or business. So if I have a trade and business and I have an asset, and let's say that the fair market value of the asset is $100,000 and it's destroyed, meaning that I could have $100,000 of a loss because that's the value of the decrease. If the actual basis of that asset was larger, meaning let's say I had a basis of $120,000, if it's a trade or business and I have that casualty loss, I'm able to take a deduction for the entire $120,000. It's not limited to just the decrease in the value of the property. Now, if this was personal use property, I would be limited to just taking the $100,000 because I have to take the lesser for the personal use property of the decrease in value or the basis. But again, if you're talking about trade or business property, if prior to the casualty, the basis was higher than the fair market value and the property is destroyed, then you are actually able to take the deduction equal to the basis, not just the decrease in the fair market value. One other item to note for trade and business property is that you have to calculate the loss for each item individually. You cannot aggregate any items. Every separate item that is part of your trade or business has to be calculated individually to determine what the total loss is. All right, so we've got kind of just a quick little slide here recapping, and again, this is just for trade or business. So if I have damaged property, the deduction is equal to the lesser of the fair market value immediately before the event, reduced by the fair market value immediately after the event, or the adjusted basis, whatever the lesser of those two is. And if it's destroyed, I get either the greater of what my basis in the property was. If it's destroyed, I can get more than just the fair market value reduction if my basis is more, which is what you see there. All right, so now we've got, again, just one more slide, general rules for personal property versus trade and business. We talked about the trade and business rules on the left-hand side. This chart, what we've got here, talks about some of the additional rules that apply to personal use property. One item to note is that as a general rule, you're not able to take a casualty deduction if you have anything in excess of your casualty gains. But that's not applicable to a federally declared disaster. So we don't have to worry about the first box for the personal use property because of the hurricane. When we're looking at personal use property, you are able to combine the land, the dwelling, and say the shrubs that are associated with the property. Now, if you were using that for a business, you would have to have 3 different calculations: one for the building, one for the land, one for the shrubs. In this situation, you're able to just combine them together, and it can have a better tax result for the taxpayer depending on what the basis is in the property and what the actual losses are, as we can see later. A couple of other items is that typically you're limited to a 10% AGI. Typically, you're limited to only claiming items that are $100 or more. In past, Congress has waived these requirements whenever we've had, in most times where you've got a situation such as a hurricane. And in addition, in a normal situation, the items that you're taking as a casualty are claimed as an itemized deduction, meaning if you take the standard deduction, you could not claim these. But again, in most situations in the past where we've had a hurricane disaster relief like this, Congress has waived that requirement. So a taxpayer could take the standard deduction and still have an itemized deduction in addition to that for the casualty loss. All right. And then I'm going the wrong way, sorry about that. All right, so these were the additional rules for personal use property, which we just talked about, which were on the slide as well. We've got an example here, which if you look at the IRS publication 584, kind of walks you through the calculation of how you're supposed to determine the casualty loss deduction for personal use property. So if we just look at this line here for the chair, it has a cost basis of $350. The client received $200 worth of insurance for the property. At the time before the casualty event, the fair market value was $275. The fair market value afterwards is $0. So the maximum that the client could receive would be $275 because that's the difference between the fair market value immediately before and immediately after. Looking at that, we have the $275 again as the value. But in this situation, because the client received $200 worth of insurance, that reduces the $275 to $75. So the only thing that can be claimed would be the $75. Going down the further line, the clock is the same idea. It's a $90 cost basis. It's a $60 value. It's worth nothing after the event. But in this situation, because the client did not receive any insurance, the client would get the full $60 deduction for the clock. And again, because we're in a hurricane, you can have this deduction even though it's under $100 in most situations, assuming that Congress does what they've done in the past. All right, so what I'd like to do then is we have 3 different examples here. I think that they're pretty self-explanatory. They're from the actual regulations. What makes me laugh is that you can see how old these regulations are. Because it talks about in 1956, he purchases a car for $3,600, which is just, it's interesting. So, but just walking through this fact pattern very quickly, if we go to the actual deduction for it, we've got a car that was worth $3,600 when it was purchased. So that's the basis. At the time of the accident, the actual casualty, it was worth $2,000. After the casualty, it's only worth $1,500. So we have $500 worth of property being destroyed. Now in this situation, because the client received $300 worth of insurance, they're only allowed to take a $200 deduction as far as the loss goes. Now in this example, what we have is we have the client purchasing land, which is an office building for the lump sum of $90,000. So again, it must have been nice in 1958. 18,000 of that is allocated to the land, 72,000 is allocated to the building. Now again, because we're talking about this being a business property, they have ornamental shrubs, but we have to include that as a different category. We're not able to lump that in with the land in the building like we would do with a personal use property. So at the time that the event happened, the adjusted basis in the building was $66,000. The adjusted basis in the trees was $1,200. So that's going to be some of our caps that we might have to look at. What happened as a result of the casualty is that the value of the building decreased from $70,000 to $52,000, and the value of the trees decreased from $2,000 to $400. $500 or $5,000 was received to recover the loss on the building. Nothing was received to cover the loss on the trees. So walking through the calculation, what we have here is that we have the value of $70,000 prior to the casualty event. It's only worth $52,000 after the casualty, so we have an $18,000 possible casual loss. What we have to do first, in addition, is we reduce that by $5,000 because that was the insurance that was received. So we have our $13,000. It's less than the basis, so we're okay there. So the casualty loss with respect to the property, to the building, is $13,000. Turning to the trees, they had a value immediately after the casualty of $400, immediately before of $2,000. So we had a destruction of the casualty loss here for $1,600. But in this situation, our basis was only $1,200. So the casualty loss is limited by the basis to being just $1,200. All right, and then the example 3 is the same exact facts, except we're using it as a private residence instead of a building that is a trade or business. So it's a personal use property, which again means that we can aggregate all the values together for both the land and the ornamental in the building and the ornamental property, the shrubberies, etc. So again, we have a situation here where the value before was $90,000. The value immediately after the casualty is $70,400. So we have a $19,600 possible loss. In this situation, because the basis of the property was $91,200, we're not limited by any basis like we were in the shrubbery example for the trade or business. And again, that's because of the fact that we can combine the properties together because it's personal use property. The only reduction we have to take into account is the $5,000 for the insurance received. And that means that the client in this situation would receive a $14,600 deduction. Again, as Carl mentioned, this is the IRS link, which has a great website with frequently asked questions, which also are reproduced on the rest of the slides. We think those are self-explanatory. And I think other than that, I think that's pretty much it from our side.
Okay, super. All right, let us go ahead and answer some questions then.
There was one question that I figured I would take because I think most of the rest were on all your categories, but there was one about how do you set up a charity class for a small employer with say 10 people. And I think this is a good sort of rule of thumb for a lot of people. I think the first thing I would start with is, can you do a 139 plan that's going to work for your employer? And is that going to meet your needs? Because if so, you've heard the Alan and Ken talk through the benefit, talk through the benefits there. I might start before I started my own charity for such a small group. I would talk to an existing charity and see if they would set up a fund for my company. One that lets them take on the risk, and two, I think there's something different about it if they have a bunch of funds for a bunch of small employers as opposed to all they do is support one employer. Theoretically, you could go in and if neither of those work, you could try to start your own organization and explain to the IRS in your application that this is the size of our class and try to get their blessing. There's no magic number, so maybe they'll say yes. I would just kind of call out that if you only have 10 employees and directors and officers, it's a company foundation, so directors and officers aren't eligible, you're kind of running out of people pretty quickly at some point, and you can only make grants to people in financial need. So, or how many of those people would sort of fall in that category? 2, 3? I'm a little skeptical, but that would be my kind of long answer. And I think a good framework for anyone doing that similar kind of math is I'd start with 139 before I jumped if I'm not a big enough thing to really have my own fund or have my own foundation.
Okay, very good, Carl. Thank you very much. All right, next question. Peter, do all Florida residents have until February 15 to file Form 1040?
Yes, if they're in, yes, they do. All of Florida's within the zone.
As long as they filed their extension on time.
Yeah. If you meet the other requirements, yes. But
you're otherwise late, then you're just getting later.
Right. One other thing I'll add is they said if you're not in the zone, but your records that you need in order to file are in Florida, then you can you're also eligible for that extension.
Oh, there was another thing. What if you're a partner in a partnership and the partnership does business in Florida? Then can you extend your personal return and wait for the partnership K1? Is that automatic?
Yes. So assuming that the partnership doesn't file the return timely, I mean, what would have been timely? If they have an extension, then you automatically get an extension because as a partner of that partnership, you're an affected taxpayer. It does not matter where you live in the country. You could be living in Minnesota and things are fine and they haven't had any emergencies, but because you're a partner in a partnership where the business is located in Florida, if that partnership is delayed filing its return, you're an affected taxpayer. The one difference is that in Florida, if you are a Florida resident and you're an affected taxpayer, you don't have to really do anything with the Internal Revenue Service. They're going to understand because they're going to see that you're a Florida resident. If in my example, you're living in Minnesota, you need to contact the IRS and let them know. There's a phone number on the website that you can contact, and you should call the IRS directly and explain to them that you are an affected taxpayer so that they have it in their system so that you don't get a notice from them that you haven't filed timely.
Okay, so Carl, on section 139, how does this apply to independent contractors? And how does it apply if it's paid from a Schedule C company or an S corporation?
I'll have to kick that one back to you, and I haven't thought about when. I always, just as the charity lawyer, think of 139 as that's where my qualified disasters are. I rarely advise on it. Do you happen to know the answer to that one? I've always assumed it applies to contractors.
I think it'll apply to anybody.
Yeah.
And I think it would apply to a child of an employee or a child of a contractor. And I think it would apply if you pay it from a Schedule C company. But I'm not to someone other than the owner of the Schedule C. I don't think you can pay it to yourself. Yeah. If you're a sole proprietor, I don't think it works to pay yourself the money and take the deduction and not include it in income. Now, I don't know whether you could move the company or the business into an S corp now and then pay it. I would try that. If I had my own company, I'm an Uber driver and my car broke down. from the hurricane. So I put the Uber driver business into a C corp, into an S corp, and then I reimburse myself for my car. That might fly. I don't know. Okay, let's see. There was flooding in the St. Louis area, and certain locations have extended due date? According to Andy, they do. So thank you, Andy. So it's not just Florida, but it's also South Carolina. Somebody asked if it's North Carolina as well. Does anyone know?
I have to drop, but do feel free to send any charity questions my way out, and I'll be sure to follow up.
Okay.
Good seeing everybody.
All right.
Thanks very much.
Good to see you. Okay, can an employer give an allowance rather than a specific reimbursement? You could try that, but the 139 exclusion only applies to the extent of the expenses that the employees had. And I would recommend that you give a specific reimbursement. I think it's okay to give in advance and say, here's 500. We're willing to cover up to 750. Give us your receipts. Then they give you 650 of receipts. You write them a check for another 150. I think that works.
Yep.
Okay, Tina wanted to know, do you have to have appraisals to support the casualty loss deduction, Ken?
You do not if you are in Florida. If you're a part of this, we're here dealing with a FEMA emergency. With FEMA emergencies, there are safe harbors in the code that do not require you to have a actual appraisal. Typically, you would need to have an appraisal done, which would calculate the value before and a value immediately afterwards. But because, again, we're under this FEMA emergency declaration, there is a carve out for that so that you do not have to have the expense of the appraisals.
Okay, David said, if you filed an extension and then you've already filed your return and you want to take the casualty loss, you don't have to amend the return, you just file a revised return. I didn't know that.
Neither did I. It's a great point.
Yeah, David may be right. If anyone wants to know if David's right, send us an email and we'll figure it out. But thank you, David, if you're right. If you're wrong, then we don't thank you. Oh, well, we still appreciate the effort. Okay. Is COVID-19 is a federally declared disaster too? How do we find out when the disaster has been lifted? That's Ruby. Ruby, all we have to do is ask Peter Farrell. He's going to find out and let you know. Okay. What about if your CPA tax preparer is in Florida and the taxpayer's in another state? You're out of luck. Sorry about that, unless you're in South Carolina or maybe North Carolina.
I'm not on that one. I'm not 100% sure though, because I think if the taxpayer is here in Florida, that because your records are here in Florida, that you might be deemed to be an affected taxpayer. But again, that's a situation where if you're out, you would be presumably outside of the state of Florida. Here with a taxpayer here, you'd need to call the IRS directly to make sure that you did qualify if you were in that situation.
Peter, is that what you read?
Yeah, I'm trying to look for the exact document that I read that, but that does ring a bell that if your tax preparer is in Florida, you might still qualify.
Okay. If I use a home business, can I deduct the mortgage interest and property taxes and insurance? Well, I don't think that has anything to do with the disaster loss.
And the only thing I could add to that for the disaster loss is if you have a property that's partial trade and business and partial private use, then you need to allocate between the two portions. It has to be treated separately. So if you have
I will say, yeah, but if you do have a home business, there are certain deductions you can get, but I don't know what they are because my CPA handles that. And I didn't have to learn it for today. All right. Ken or Peter, anything you want to say to go ahead and end this?
No, I think we've covered everything that we wanted to, and you know, like you had mentioned earlier, just our condolences to everybody that's been affected by this, and hopefully this webinar has been helpful for people to be able to at least maximize the benefit that they can get on reducing their taxes as a result of what they're going through.
Yeah. You do have our emails there. If you have questions or if you have comments or suggestions for this presentation, please just let us know. I'm Gassman at gassmanpa.com. Ken is Ken, K-E-N, at gassmanpa.com. As always, if you'll send the easy questions to me and the hard questions to Ken, we'll get them all answered. Please feel free to forward the email that you're going to receive in a couple of hours to anyone who could benefit from this presentation. We'll also be posting this to YouTube. Please consider helping others, and have a great rest of your day. And hopefully Brittany will turn this off soon.